Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our IFRS 17 webcast. Today we're going to talk about the IASB completing its final round of IFRS 17 amendments. The level of aggregation doesn't change. That's the title that I've chosen for today's webcast as the main highlight of the meeting that the IASB held on the 14th of March 2019, last week. The agenda is traditionally structured around these three items, starting with the highlights, then detailed analysis of the IASB discussion and of the decisions reached, and then a few minutes at the end to talk about the next steps. Let me just move quickly then onto the highlights. The main one, as I mentioned in the title, is the fact that the IASB has decided to retain the IFRS 17 requirements on the level of aggregation, unchanged to what they were in the published text of IFRS 17 in May 2017. The IASB also has reached some decisions which should be seen as positive by the life insurance industry, given that what they have done, they have effectively made two amendments to the transition requirements on the risk mitigation option, the VFA hedge accounting, as I call it. The first one is they allow us effectively to apply that from the transition date rather than the effective date. So it's one extra year in the past that we can go back to in terms of presenting the effect of the hedge accounting. So that means that you can have the two comparative P&L on a like-for-like basis. The other one is that they have introduced a more extensive application of the fair value approach, subject to certain conditions, and I'll tell you a bit more as we go through the detailed slides on the meeting. They've also added a new scope exemption. This one is for credit cards with insurance coverage, similar to the loans that they have already discussed and agreed last month. This one follows the same approach of being taken out of the IFRS 17 application into IFRS 9 instead. Finally, they have also made several disclosure amendments because they have effectively taken into account all of the decisions to date and made effectively what are consequential amendments to the disclosure section of IFRS 17. We spent some time actually to analyze each of those ones because from an implementation perspective, we often talk about some new numbers or new tables that will have to be implemented. But let's now start the discussion on why the IASB decided not to change the level of aggregation of insurance contracts. Just as a reminder, although I'm sure that probably everyone knows this already very well, but just to make sure that we all remembering what the requirements are, we have effectively three major principles in IFRS 17. The first one is the insurance contracts that an entity issues must be grouped first in a portfolio. Portfolio is open-ended and is determined by looking at having contracts with similar risks and managed together. The second one is then the subdivision of the portfolio in profitability buckets. At Deloitte, we actually look at the third requirement first, which is the subdivision of the portfolio into annual cohorts. If you think about the open-ended portfolio, it would be most logically to chop it into annual cohorts first, and then to apply the analysis of the profitability buckets within each of the cohorts to create up to three groups of contracts. One is the group that is aggregating all the onerous contracts, the ones where the expected outflows are greater than the expected inflows on initial recognition. And then two profitable groups, one that is profitable without any significant possibility of becoming onerous in subsequent periods, and the other one is the rest. So two profitable contracts groups and one onerous contract groups. Stakeholders are concerned mainly because of the annual cohort requirement. So they think that the requirement will not provide financial statements users with useful information because the annual cohorts are effectively chopping portfolios into closed books of no more than 12 months of issued contracts. And that doesn't appear to depict the business performance in an accurate way because it doesn't reflect the pooling of risk that is done at the portfolio level. I'd like to mention that Deloitte has been on that particular camp, and we have put that in writing in our comment letter back in 2013 when we were suggesting the use of the annual cohorts for allocation of the CSM. But then we recommended to the IASB that the unlocking of the CSM was done on a portfolio basis with a proportionate adjustment to all of the individual CSM balances in the groups. So Deloitte was actually at the time thinking that annual cohorts actually are useful for allocation to P&L, given that that is a reflection of when the service begins. But the adjustments to the CSM that effectively reflects the changes in assumptions determined most often at the portfolio level should be done at that level of aggregation, not at the group. As we know, the IASB did not accept Deloitte or other stakeholders' recommendations in that direction, and we have the group based on the three requirements set out in the top half of the slide. The second concern is around implementing this requirement from a cost perspective. A number of stakeholders are concerned that those costs are likely to outweigh the benefits, given the extensive system change that will have to be implemented. And then finally, there are concerns that perhaps this is a difficult way to achieve certain outcomes, and there could be maybe simpler ways to do that. And so suggestions have been given to the IASB to consider. In particular, the IASB have taken three suggested amendments of the standard with regards to the level of aggregation, and specifically commented them in the paper that was discussed last week. The first one is to reduce the number of profitability buckets by removing effectively the differentiation among the profitable contracts. In effect, it just leave one group of onerous contracts and another one all profitable contracts. The second suggestion is to replace the requirement for the level of aggregation with some approaches that would be more closely aligned to the insurance company's internal management philosophy. And then the last solution proposed by stakeholders was to remove the requirements of annual cohorts, at least for the variable fee contracts, or for the variable fee contracts that fully share the risks between policyholders. The question obviously was whether the board agreed that these requirements should be adopted in the current phase of IFRS 17 amendment discussion or not. Also, the IASB staff noted that the IASB already agreed in December to elevate a level of aggregation requirement from group to portfolios, and that was for presentation when you remember probably the IASB agreed to take out of paragraph 78 the requirement to present groups of insurance contracts that are assets and liabilities, and instead to introduce the requirement to present portfolios of insurance contracts that are assets and liabilities on the face of the balance sheet as a minimum. Having said that, the IASB staff also note that measuring insurance contracts at a level which is too high in terms of level aggregation could create some problems from their perspective, and they reminded the IASB that there are a number of important objectives that IFRS 17 attempts to achieve with this level of aggregation. The first one is that they want to depict the trend in the entity profit over time. The second one, they want to make sure that there is a timely recognition of profit on profitable contracts, so that all profit has been recognized by the time the coverage period is ended. And finally, they want to make sure that the standard operates in a way that there is a timely recognition of losses on onerous contracts when they emerge. In particular, the timely recognition of changes in the probability that results from the changes in cash flows would give more transparent information, and that should contribute to an improved understanding of the insurance sector by investors and ultimately long-term financial stability. The IASB staff noted that in their opinion, the requirements in IFRS 17 already strike the appropriate balance between a much more granular level of aggregation, as it was initially proposed by the IASB, and what has eventually been introduced in the text of IFRS 17. And in the opinion of the IASB staff, the burden that comes is entirely justified by the benefit that you get from producing that information set out in the bullet points of this slide. So then they moved on and analyzed the three solutions proposed by stakeholders in the area of level aggregation, starting from the reduction on the number of profitability buckets. Now, the summary of the discussion is that onerous groups are more likely to arise from subsequent changes in expectations if the group of contracts is made up of a large number of profitable contracts. If you then limit that to the single bucket as recommended, then there will be contracts that will actually stop being profitable at a later stage, but because they belong to the same group, they will not trigger a P&L onerous loss. And that is what creates the timeliness issue around the recognition of onerous losses that the IASB staff feels is significant and therefore not acceptable. This is useful information. The fact that the assumptions that the IASB has requested each insurance company to revise at every reporting date must be analyzed on a group-by-group basis, and that this distinction between the sensitivity of the initial profit expected from the contract to those variables is an important economic substantial fact in the opinion of IASB staff that must be reflected in the level of aggregation. And so the conclusion is that given that all that will be lost by effectively creating a single profitable group of contracts, the proposal is deemed to be unacceptable. Then the IASB staff analyzed the idea of replacing the requirements altogether, introducing something which is more aligned to the entity internal management. For example, removing the requirement for annual cohorts. The IASB staff observed that these will be effectively creating the three profitability buckets, but on an open-ended time basis. So effectively, it will be an integral part of the open-ended portfolio without having to split them. This could live for the entire life of the portfolio, of course, and the CSM would effectively become the average within the profitability that you have created by having these type of buckets. The effect of that averaging of profits across the contracts in the open-ended bucket would then leads to a greater possibility that the CSM would outlast the coverage period of contracts in those open-ended buckets, and also create a much greater possibility that if there are subsequent adverse changes in the expectations that inform the estimate of future cash flows, some contracts that are onerous will effectively have their onerous effect absorbed by the continuing profitability of the other contracts. Because of all these reasons, the IASB staff recommended that having this type of level of aggregation as a basis for IFRS 17 is not acceptable. This will create loss of useful information and therefore fail one of the key criteria agreed unanimously in October last year by the IASB, and so the recommendation was also not to take up this solution. The last idea was focused on VFA contracts and at least try within those contracts that will have mutualization to see whether the annual cohorts can be eliminated. And the IASB staff put together this simple example. So if you bear with me, I think it's useful to actually see these figures. These are two groups of VFA contracts which are issued one year after the other. So group one, at the initial recognition, has got this CSM of 433 currency units, and then 1 year later, or effectively before group two is recognized, it goes to 531, And then Group 2 comes in with a 761 loss, effectively. If you then ignore mutualization, that loss will be going through P&L. But when you apply then the mutualization paragraphs B67 to B71 in IFRS 17, given that those contracts effectively have resulted in each policyholder agreeing to a transfer of part of their benefits to the other portion of the portfolio, then the policyholders of Group 1 effectively agree to lose 700, well, actually more than that, about 800 currency units of their underlying items in favor of the second group, which then lands on a CSM of 145 currency units. That is an important distinction. So the two CSM will have to be kept separate, and the annual cohorts must be applied. Because although stakeholders have observed that you could take a view under column E and just book the total CSM at 676, the IASB staff observed that if you don't keep the profit separate for the annual cohorts, you end up having deferral and profit recognition issues as you serve different coverage periods across the two groups. And that will obscure the trends in profitability, because if you think about it, the fact that policyholders share the underlying items returns across generations, it doesn't mean that the insurance company receives the same profit from all the contracts across the generations. Because of that, that fact, the IASB staff thought that removing the annual cohort requirements, even when there is mutualization and intergenerational returns sharing, would be an acceptable loss of information in terms of profitability trend that would be present in the financial statements. And so because these will result in an averaging as similar to the other two solutions, then the IASB staff recommended that it should not be accepted as a valid amendment to IFRS 17. The board, having read all these analyses and having considered it, went on to discuss what to do, and it was, if you actually replay the IASB webcast, you can see that there is a very high level of energy in the statements that all the board members that spoke on this issue actually make in the meeting, in the public meeting. They were of the view that their decision when they set this level of aggregation is the appropriate balance between the cost that preparers will have to incur and the level of usefulness of information that investors will receive from the financial statements. That remains valid in the eyes of the IASB. They also noted that if they're going to set the boundary for an exception from the annual cohort requirements in IFRS 17, that would actually add complexity rather than reduce complexity, because it would create the risk that the boundary would not be robust enough and appropriate in all circumstances. The staff also expected that some of the stakeholder concerns about the difficulty of applying these requirements in transition would be alleviated by the fact that there is a fair value approach for transition, and that provides you with an exemption from applying the annual cohort if you end up choosing that approach. All of the suggested changes, in the opinion of the IASB staff, from the stakeholders, would result in unacceptable loss of useful information, as explained earlier, particularly in relation to the trends in the profitability. And that was a point that several board members, in their own personal statements before voting, actually reiterated as a very important characteristic that they wish to achieve from IFRS 17 application. And so when they were called for the vote, the recommendation not to do anything about it was unanimously supported by the board. So let's now move on to the area where actually some changes were approved. And this is, I think, a piece of good news from the IASB to the life insurance industry, where the VFA hedge accounting is probably most commonly found when you look into insurance companies today. The staff asked, given the decisions reached in February, whether there should be a new approach, and this new approach will be to amend the requirements of IFRS 17 and permit an entity to apply this VFA hedge accounting prospectively, but not from the date of initial application, instead from the transition date of IFRS 17. So if you are a calendar year entity, that means the 1st of January 2021, the first balance sheet in the comparative period. They acknowledge that the prospective approach that was approved by the IASB in February should remain, but what they're just suggesting now is just to do it from the transition date, as long as certain conditions are met, and in particular, all the criteria in paragraph B116 must be met prior to that date. So on the 1st of January 2021, if you're a calendar year entity, you must have already done all the designations, the risk management policy, etc., before you are allowed to use this accounting treatment from that date. That means also that the P&L for the comparative period will be accounted for in the same basis as the P&L of the effective period 2022, and then prospectively this will be providing a trend of likely accounted transactions into the financial statements of the insurance company. Based on that analysis and on these considerations, the recommendation was to change IFRS 17 as a result of that, and the vote was unanimous in favor of this proposal. And then the IASB staff said, well, there is also another way we can try to fix the opening balance sheet, and that is by effectively twisting the current guidance on transition. As we all know, the general principles is that IFRS 17 must be applied retrospectively, and you must try to apply that as far back in the past as necessary until you reach a point when it becomes impracticable. At that point of impracticability, you then have the option to choose a fair value approach or a modified retrospective approach for transition and restatement of the older contracts that are still in force on the 1st of January 2021. The IASB staff is saying, well, if an entity applies the VFA hedge accounting prospectively from the transition date and on transition has made that decision and has got all the relevant characteristics, including having used derivatives or insurance contracts before the transition date, then that entity will be given the option not to try to establish the impracticability point in order for to apply the VFA transition approach. So the fair value approach, you can instead apply the fair value approach on transition date for those groups of contracts where these conditions are met. So that means that you are allowed to fair value the VFA contracts, and given you also fair value in the derivatives and the insurance contracts under the fair value approach, of course, of 17, you have effectively fair valued the full relationship, hedging relationship in your books. So that should eliminate substantially the accounting mismatch. It will prevent cherry picking because you are fair valuing the whole set of contracts. And so you have effectively identified an approach that is adequately robust and still allows you to mitigate the problems that were brought to the attention of the IASB. The recommendation was therefore to make the amendments in transition guidance in Appendix C, and the vote was once again unanimous in favor of that recommendation. The next topic was credit cards that provide insurance coverage. As we know, there is a concern that some banking products like credit cards and loans may transfer significant insurance risk as well, and therefore the application of IFRS 17 at the moment is mandatory. What the IASB staff has heard from a number of stakeholders is that there are concerns that some entities really have just this limited number of banking type products with a transfer of insurance risk which is significant, and therefore it could be argued that those entities may have to incur a cost for implementing the requirements of IFRS 17 on these credit cards, for example, which may outweigh the benefits that the users of financial statements of those entities will receive from the application of IFRS 17, particularly when you compare it against the application to the same transaction of IFRS 9. Effectively, you will then have to test these arrangements under the IFRS 9 classification criteria and decide then, based on the outcome, whether you can use the amortized cost or the fair value through P&L. That seems to be an equally valid way of accounting without diluting the usefulness of the resulting financial information. And so what the IASB staff proposed here is that also for these credit card contracts, there should be an exclusion from the scope of the standard when the entity does not reflect an assessment of the insurance risk associated with an individual customer in setting the price of the contract with that customer. And the board approved this unanimously. So we will have another scope exemption informed by these pragmatic considerations. The IASB then went through a very long list of sweep issues to actually make the necessary amendments on transition requirements and a few other aspects of both IFRS 17 and IFRS 9 in order to take into account the decision they reached last month to scope out by designation certain loans that transfer significant insurance risk at the same time. And the various combinations from a transition perspective would be whether you elect to use IFRS 17 and then you have to follow certain transition rules, or whether you elect IFRS 9 and you do that by applying IFRS 9 at the same time as IFRS 17, or when you elect to use IFRS 9, but you apply IFRS 9 before applying IFRS 17. So all these combinations have been analyzed. A number of changes have been proposed, all voted unanimously by the IASB. In my opinion, there was none of those amendments to the two standards which presented particularly interesting content beyond the specific small group of entities that will have these loans on their financial statements, and so I decided not to expand beyond this slide on this topic. But there is more detail, a lot more detail, if you like to have it, that we can make available to you on request. Then the last topic was around the consequential amendments on both disclosures and transition requirements. So what I've got here is a table that goes through the various topics where an amendment has been tentatively decided, starting from the one we just discussed. So for the scope changes, there were both disclosure and transition amendments, which I have already commented previously. So let's move to the second one, which is the one approved in January on insurance acquisition cash flows for renewals outside the contract boundary. There will be no changes in transition requirements for that particular new requirement, but from a disclosure perspective, we will have some important changes. The first one is a reconciliation of the asset created by this insurance acquisition cost being captured as pre-coverage assets. The disclosure will explain effectively what happened from the beginning to the end period, including the financial statements, and in particular reporting the changes that result from impairment losses or reversal of impairment losses and the allocation to insurance groups of contracts. Also, there will be a disclosure, a quantitative disclosure, whereby the entity will have to disclose the appropriate time bands that will be necessary to understand the time period required to fully allocate the balance in the balance sheet from these pre-coverage cash flow assets. The two decisions on the refinement of the coverage units calculation, the one in January for indirect power and the one in June last year for VFA, will create no changes in the transition requirements, but they will create new disclosure requirements. The staff recommended to introduce quantitative disclosure for the time bands that will be depicting the expected recognition in P&L of the CSM balance at the reporting date, and also specific disclosures that the entity will have to think through in order to explain the approach of assessing the relative weighting of the benefits provided by the insurance coverage versus the investment-related service for VFA or the investment return service for the indirect power contracts. The risk mitigation exception that was debated in January in terms of application when an entity uses reinsurance contracts will have neither disclosure changes or transition changes. So that effectively applies without any extra disclosure or any changes in transition requirements. Same is true for the changes in the accounting for reinsurance contract held when the changes in cash flows from those reinsurance contracts held should be taken to P&L because there are underlying insurance contracts which are onerous at initial recognition. Again, no disclosure requirements on top of the change in measurement, and equally no transition changes on these. When you will have to restate the insurance contracts, you will have to take into account the specifics of the changes in cash flows in the past based on the existing transition requirements without any further guidance being necessary. The presentation, simplification, the one that effectively now allows insurance companies to use the portfolio as the basis for aggregating the balance sheet assets and liabilities, will have no transition amendments, but there will be some alignment internally, effectively to the fact that now we have changed the level of aggregation, and so there will be amendments to paragraph 99 so that when you disclose the reconciliation required under paragraphs 100 to 105, you refer to portfolios rather than groups of contracts. And then on the amendments to the effective dates for IFRS 17 and the amendment to the temporary exemption from the application of IFRS 9 being moved forward by 12 months, there are no disclosure changes. All the disclosures for 17 come from 17 when applied. And IAS 8 in terms of IFRS already issued but not yet effective. And for IFRS 9 deferral, IFRS 4 has been amended extensively to actually produce a comprehensive body of disclosure which remain in place for 1 extra year potentially. Obviously, no transition consequences from either of these decisions. And then finally, obviously, not applicable from a transition perspective, but the additional specified modification to the transition approach for the liability that relates to settlement of claims incurred before an insurance contract was acquired will not produce any new disclosures, and because it is an amendment to transition, of course, it is in itself an amendment, so no further amendments will be required. So that was the last decision, again approved unanimously from the IASB last week. In terms of the next steps, there will be another discussion opportunity for any final sweep issues in the board meeting that will be scheduled during the week 8 to 12 of April. That will be the final public discussion before entering into the balloting stage and publishing then the exposure draft by the end of June. There is also going to be a TRG meeting, so on the 4th of April I'll be going to London to join my fellow TRG members, and the TRG the TRG agenda will be published imminently, either tonight Hong Kong time or tomorrow probably. And we have been informed that the agenda will be rather short compared to the other events, certainly not as long as the 2-day TLG in September. So prepare yourself for perhaps a little bit less reading than usual. If you want to follow us again, register either for a physical presence if you are in the neighborhood of the London office of the IASB, or by webcast if you prefer a virtual connection. The technical plan confirms the publication by Q2 2019, and also we have already shared and confirmed once again that the dual process oversight board has agreed to a short common period for this exposure draft, which is less than 120 days. I predicted that the board will choose the 60 days option, but it may also be that they choose the 90 days. So we'll see when the document is out. That is the last of my updates for you from the meeting held on the 14th of March. And with that, I'd like to stop the recording and open the floor for any questions.